Coming up today, stocks attempt a reversal day after the worst quarter in years on the back of peak uncertainties. Goldman Sachs raises recession odds, gold hits an all-time high, and have we seen maximum fear in the markets? It's going to be a monster week, guys. Let's go. And there we have it, folks. The last trading day of March and Q1 2025. As we get down to crunch time, the US president set to announce the most widest and sweeping global tariff any of us have seen in our lifetimes this Wednesday. On top of an action-packed week, we got manufacturing and services PMIs coming in, jobs report on Friday morning, followed by Fed Chair Jay Powell delivering a speech as well. Just looking at the heat map here, we actually finished mostly in the green. Still, mega cap tech doing their own thing relative to the rest of the market, and a continued defensive feel in today's trading. But it was a classic start of the week, maximum fear. We had a monster gap down. Just looking at the 5-minute chart here on the spider. At one point early this morning, we were down almost 2% below Friday's close, and Friday was a pretty weak day as well. But the market found its feet early on in trading, and it was up until the right for the rest of the day, giving us what I think is the most constructive candle we've had this entire correction. It's actually a really bullish signal when you get a monster gap down, the market finds its feet and closes above prior day's close like we did today. Not as convincing on the Qs though, closing exactly flat on where we finished Friday, and a little less convincing on the Russell 2000 again as well, not managing to reclaim Friday's close. And even though the S&P 500 finished higher in the day, so did the VIX. That's not really a good sign either. At one point this morning, almost hitting 25, quite elevated, and we're still on the dicey zone with the VIX term structure and backwardation, and the market seems stuck in the extreme fear zone. We've been here over a month now. In addition to investor sentiment being some of the most persistently worst readings we've seen in many, many years. In fact, American stocks just had their worst quarter in 23 years relative to the rest of the world. You have to go back to the early 2000s and the late 80s to find a similar underperformance of US stocks versus international stocks. And that's actually pushed the Magnificent Seven, mega cap tech stocks, into a technical bear market. The average Mag 7 member is down almost 25% from its 52-week high. Currently one of the biggest drawdowns we've seen over the last decade. And once again, the narrative is building. Is American exceptionalism in trouble? Have we seen the best of it? Is the desire from the new admin to level the global playing field on tariffs, marking the end of America's long outperformance over the rest of the world, as many people seem to think so? Just looking at the year-to-date returns here, looking at a couple of dozen well-traded country ETFs. We got Poland up 36% year-to-date, Greece 24%, Spain 23%, and so on. Even United Kingdom is up over 10%, with China, Switzerland, Brazil, and Germany doing even better. Or is this Liberation Day coming on Wednesday, the 2nd of April, going to be a bit of a line in the sand? Sell the rumor, buy the news potentially. Just saw the Nikkei take a bit of a sharp pullback today. And looking at the spread of the American Spider versus the Vanguard Entire World ETF, excluding the United States. Once again, a bit of a constructive candle here today, pushing off those lows, suggesting we may have already seen a bottom in the relative performance of American stocks versus international stocks. And I know it seems almost crazy to do in this environment, and no doubt will trigger some, but I'm going to present some bullish data to you right now to help make your mind up on everything that's happening at the moment. So no doubt we've got peak fear, uncertainty, pessimism, expectations, not only on the downside with the economy potentially going into a recession, but also on the upside with inflation. But looking at the hard data, key drivers of the economy continue to hold up. And so whilst we're getting a little bit of a spike federal initial claims, there's just so much going on here at the moment in the markets. Not just tariffs, but the US government seeking to become smaller, laying off a lot of federal employees, a huge crackdown on immigration, in addition to big changes in government spending. But a big key driver of the market is the unemployment rate. And that's led by initial claims here in the dark blue line, people filing for unemployment benefits. It's actually come down over the last couple of months and hasn't been spiking thus far. Another key indicator for the health of the economy is how many people are moving around. Air traffic actually accelerated briefly in the last couple of weeks. And looking at 2025 data here in the yellow line, we're actually tracking above 2024 and well above 2023. Typically going into recessions, people start traveling a lot less, both consumers and businesses. We're just simply not seeing that right here. But what we did see on Friday was United States personal income print its third highest month-over-month rise in the last 3 years. People are still making money, but for sure, a lot of them are worried and may indeed pause their discretionary purchases. But if and when things calm down, that could lead to some more pent-up demand, potentially later in Q2. Because markets hate uncertainty. Fear is always overpriced. But once the event passes, even if it's as bad as expected, the market can then work with known variable. Hedges can be released. Buying can come back into the market. Are we going to see that this Wednesday night, Thursday morning, when we know what we're working with tariff? Technically speaking, when we get the market selling off sharply and then bouncing back, that typically bodes well for forward returns, but can indeed bring with it more short-term volatility, as we've seen in the past. When the market hits a 6-month low and then we get a bounce back, it can quite often represent buy the dip opportunity. And so can buying stocks when most people are giving up on them. Like I said, we've got peak fear and bearish sentiment at the moment. Looking at the 5-week moving average of the AAII Investor Sentiment Survey, we've actually got worse sentiment than back in 2020 and the GFC from 2008. In fact, we've only seen this level of bearish sentiment twice before in the past. Previous bear market we had back in 22 and the recession we had back in the early 90s, savings and loans crisis. Is this time different? What do you think? Do you think US tariffs are going to end up being way worse for US stocks than international stocks? Will Europe be the place to be for the rest of this year? Is gold going to keep outperforming? Let me know your thoughts in the comments below this video. I'm interested to hear how you're seeing all this. Because me personally, I'm a long-term bull. We can always trade around the short term, put on hedges, but I'll always be a net buyer of stocks. And one thing us bulls love to see is when this guy gets bearish, and that's exactly what we got this morning. Jim Cramer coming out and saying, I can't think of a dumber day to buy stocks than today. And when he comes out and says things like this, these are the kind of statements we come back to in 6-12 months and say, look, it was clear as day. The writing was on the wall. Or is this time different? And it really is a dumb day to buy stocks. But no doubt the uncertainty is real. This new admin seems determined to go ahead with their mandate and levy tariffs on countries that do the same to US goods, hence the label reciprocal tariffs, an eye for an eye. And the thing is, we just don't know exactly what is going to be announced by the president on Wednesday. I think they're still working it out themselves. Are all countries going to get hit, or just the top 15 trading partners? Is there going to be exemptions for certain industries and products? Are some countries going to get hit harder than others? We all really don't know, hence the market is on edge. And the odds of the US seeing a recession this year continue to climb. Prediction markets now on their way to a 50-50, where the United States goes into a technical recession this year or not. Even one of the largest, most influential investment banks on Wall Street, Goldman Sachs, just lowered their S&P 500 year-end target and raised their recession odds as well, pointing to the new admin being more aggressive with their tariffs than they had initially forecast. Their end-of-year target on the S&P now 5,300. We closed just above 5,600 today. And Goldman Sachs economists lifted the probability of a recession to 35% from their previous 20% probability. And that's probably a level I would agree with as well. No doubt the odds for a recession have gone up, but I still think they're a little bit lower than 50-50. They also raised their forecast for year-end inflation to 3.5%. Kind of what is there for the market to not worry about, right? And that's because they expect the average US tariff rate to rise 15% this year, 5% more than their previous baseline, saying higher tariffs are likely to boost consumer prices, and that's why they've lifted their inflation forecasts and recession probability, thinking GDP is only going to grow about 1.4% this year. And just looking at an earnings per share scenario, their baseline forecast now is we're only going to see year-over-year growth of 3%. If the market keeps trading on its current forward PE, they forecast the market to end about flat. If earnings did come in as they had been previously expected, they only think we're going to get a 6% rise of 5,900. But they think if we get a recession and earnings contract 11% year-over-year, and even if we go back to a 10-year average on the forward PE at 18 times, the S&P could actually lose 4,000 and the market could go down 30%, with their worst case scenario being down 44%. So that's the thing, isn't it? Is this new administration going to stick with their hardline strategy if the economy does look like it's about to go into a recession? What happens if the stock market comes off another 10-20%? Will we still get that White House put? Will they pivot their strategy, dial back tariff? Or will they continue in their pursuit to level the global playing field with tariffs regardless of what's happening in the short term in the economy and stock market? That is still yet to be seen, and no doubt causing the market a lot of bit of worry. And that's why I think this whole correction kicked off with the vigor that it did. The market suddenly woke up to, hang on, we don't really have the same White House put that we did back in his last first term. Things are different this time. And that's why we're getting a lot of calls for a recession, where to hide out. Financial advisors telling clients to pivot into into defensive assets, even talking about tapping home equity. But if we manage to avoid a recession, the next thing people will be worried about is our price is going to get too hot again. Are we going to get stagflation? There's just so much up in the air, so many uncertainties. It's really no surprise to see the volatility and fear we've got in the markets at the moment. And for sure, Q1 GDP could come in soft. Going to have a lot of volatility and economic data. And so it shouldn't be surprising for it indeed to come in at an annualized rate of maybe 30, 40, 50 basis points. Consumers are on edge here. And like I said, even though they're employed making money, they may be holding off discretionary purchases until later in Q2. We should see a bounce back. But I do think if the economy looks like it's on the cusp of going into a recession, say Q1 comes in shocking and Q2 starts tracking close to flat as well, I think the White House may get politically pressured to dial it back on the tariffs. And so they are elastic. And so in this situation with maximum fear, the narrative and price action in markets could change dramatically and quickly when and if it does. So I get asked a lot, with all this fear out there, would it be a wise move to short stocks, short the market? And whilst there's nothing wrong with having some hedges, as I've mentioned many times before, I do the same things myself with VIX options and other things like that. I'm never completely out of the market. I'll always have long-only portfolios where the majority of my wealth sits and just ride out the corrections, bear markets, crashes, whatever, with diversification and keep buying more shares every month with savings. But being completely out of the market or outright net short is much harder than it looks. And just like one of the best hedge fund managers of all time, Stanley Druckenmiller, who's averaged a whopping 30% average annual returns, he even recently said he's not sure if he's ever made money shorting, and there's very few people in this world that can do so in the long term. And like Warren Buffett always said, never bet against America. It's the world's home to capital for a reason. But a diversified overall portfolio has actually been helping investors after the end of this rough Q1, with gold just hitting a fresh all-time high. In fact, posting its best quarter since Chernobyl, the nuclear disaster back in 1986. Miners have started perking up as well for the first time in a while. But is this trade too getting a bit long in the tooth? Just seen record inflows into gold funds, 12 billion in 2 months just into ETFs. And there's a look at gold futures, currently sitting at 31.50 an ounce. Silver as well, just hovering below its 52-week highs. And there's a look at the gold miners ETF and even energy shares, pushing up to the top end of their 52-week range as well, on the back of a sharp rise in crude oil today, as the White House threatens curbs on Russian oil, as we're still getting plenty of back and forth, that situation. And just looking at some other interesting chart that stuck out to me here today, semiconductors, getting down to a key support zone here this morning, briefly touching a key support zone we've seen hit twice in the past year. This is a key sector for the market, kind of at a fork in the road. Are we going to print a new low here, create a new swing low? Same for the robotics and AI ETF, bots, trading within the range of that massive gap down we got on the 5th of August, but did put in a bit of a spinning doji hammer candle here. Another one sticking out today, the worst performing sector, biotech, falling hard as a key FDA official was ousted, as the new admin's also doing a massive overhaul of the healthcare system. And who would have thought Bitcoin would be down over 24% since the new pro-crypto president took office? Another bit of a gotcha contrarian trade by the market here, causing the United States' largest crypto exchange to fall even further, still down 42% since inauguration day. And that's Coinbase. However, if crypto is going to bounce back, this could be presenting a buy the dip opportunity. And just looking at the relative spread of Coinbase versus the iShares Bitcoin fund, this is the lowest it's ever traded ever since iBit came onto the market early last year, meaning Coinbase has underperformed Bitcoin, and especially in the last month and a half as well. There's a look at the 2-year yield, also pulling back a bit there today, getting down to 383. Not much change though in interest rate expectations. Market's still given about a 3/4 chance the Fed will cut in June and maybe even cut again in July. And if this market panic goes on, as long as we don't get hot CPIs, there certainly is a window of opportunity for J Powell to come in there and do a cut or two. And then if we don't get a recession, this could set up for a strong bounce back in the stock market, maybe coming out of Q2, going into Q3. But for the here and now, the bond market doesn't seem to be screaming recession alarm. If anything, looking at tip spreads, market's still more worried about upside risks to inflation. And so just wrapping up this daily market review, this is a big week, pivotal. We've got a lot of key indices and sectors sitting at big support zones. What exactly is the White House going to announce this Wednesday? How wide sweeping are the tariffs going to be? Will the US's major trading partners bite back with their own retaliatory tariff, which will for sure make this situation more worse or messy at the least, as the new president doesn't look like he's going to back down. We don't know when that White House put could potentially kick in and he dials them back. And on top of all that, what a manufacturing and services PMI is going to come in this week, including the jobs report due out this Friday morning. Unemployment rate expected to be 4.2%. Then we get to hear from J Powell. Is he going to lean more dovish and pointing to lowering rates? or will he lean more hawkish and hint at maybe needing to raise rates? My bet is he'll probably continue to walk the line, stay somewhat neutral, but point to rising risks, which the market may indeed interpret as being dovish. But like I said, typically markets get really uncertain going into the major event, and then when that event happens, even if the bad news happens as expected, the market can then work with some known variables, and that's what we're really lacking here. It's all up in the air. We don't know exactly what we're about to get, and so for many investors, they're just sitting on the sidelines or indeed buying some hedges, like we can see in the elevated VIX index. And that's why the VIX 9-day is much higher than the VIX 30-day at 25, because over the next 9 days, we've got tariffs, potential bitebacks, and the jobs report on Friday. It's going to be an action-packed week, guys. Make sure you stay locked in here with Click Capital, and I'll keep you on top of it all. Thanks very much, and I'll see you again this time tomorrow. Cheers.